Now we will learn about the balance in the capital account. What is this balance in the capital account? Just as we learned how theoretically we balanced the components in the current account, likewise we will balance the components in the capital account. We know what all are the components of capital account: capital receipts and capital payments. So how we have balanced the current account, likewise we will balance the capital account. That means where credit side is equal to debit side. Now regarding the balance in the capital account, let us discuss it point wise. Point number 1, the transactions which lead to inflow of foreign exchange are recorded on the credit side. Transactions which lead to inflow of foreign exchange. Inflow of foreign exchange can be always recorded in the credit side. What are the examples for the inflow of foreign exchange? When we are selling some shares, we will get money. When we get loans from other institutions, for example, I told you government and private organizations take short-term and long-term loans. When they take loans, they will get the loans. So that loan is an asset for them for the time being. So that can be recorded on the credit side. When they repay it, it becomes a liability, then it can be recorded on the debit side. So the amount that they receive as loan now can be recorded on the credit side. And that is why it is written here, sale of shares and receipt of loans. Receipt from the sale of shares when we sell the share, and the receipt of the loans that we receive from the rest of the world, means abroad. So for these we will be getting the money for us. Therefore it can be recorded on the credit side of the capital account. Now the next one is the debit side. The transactions which lead to outflow of the foreign exchange are recorded on the debit side. Outflow. What happens to outflow? What happens when there is outflow? Money is going out. That means when we repay the loan with the rate of interest. The private institutions and government will take loans. So they have to repay it later with the rate of interest. So money is flowing out. In that case, it is a debit side. We record the outflow of money on the debit side. So all kinds of outflow of foreign exchange which are recorded on the debit side, they are recorded on the debit side of the capital account. So you have an idea what all things comes under credit side and what all things comes under debit side. Example, I told you repayment of loans, purchase of share. There will be a confusion regarding the purchase of share. When we are purchasing the share, now we are giving the money. Money is flowing out. In that case, it can be debited because money is flowing out. But once we purchase that share and when we are keeping it with us, it is an asset. Why? Because at the times when there is a favorable situation, we can just sell it and make money. That is why it is known as asset. So it can be two-sided. It acts as a liability, at the same time it acts as an asset. Liability in the sense when we are purchasing it, money is flowing out. That is why we are recording it in the debit side. But once we sell it, once we purchase it, it is an asset. I hope it is clear to you. I hope that confusion is clear to you. Purchase of share. Purchase of share means money is flowing out. Definitely it has to be recorded on the debit side as the money is flowing out. But later on when we sell it, we will be getting money. At that time it becomes an inflow. It becomes a credit. So all the transactions which cause for the outflow are recorded, outflow of money are recorded on the debit side, that is negative side, repayment of loans and purchase of share. Then comes the next one. If there is a balance between the debit items and credit items, we call it as balance of capital account. So the net value of credit and debit balance is called the balance of capital account. When the credit items equals debit items, we can say there is a balance of capital account. Now, what happens when either the debit or the credit is more or less? That is what we have to learn again. We can say there is a surplus of capital account. When do we experience a surplus of capital account? When the credit is more than the debit, we can experience a surplus on the capital account. When credit is more than debit means what? Credit is inflow and debit is outflow. So when inflow is greater than outflow, there is surplus on the capital account, because inflow is more than outflow. So there is a surplus in the capital account. Now, when will be there a deficit in the capital account? Deficit in the capital account happens when inflow is less than outflow. That means credit is less than debit. Inflow is less than outflow. So when inflow is less than outflow, the country experiences a deficit in the capital account. Deficit in the capital account. So the 2 points, surplus on capital account where credit is greater than debit implies net inflow of foreign exchange. Deficit in the capital account where credit is lesser than debit implies net outflow of foreign exchange. The point which I have written on the board, you can write it in another way. How will you write it in another way? See, surplus on capital account. Capital account can experience a surplus when credit is more than debit. That is also okay. Now next, deficit in the balance of payment. A balance of payment experiences, a capital account experiences a deficit when credit is lesser than debit. So you can write the point in that way also. Both implies the same thing. So if there is a balance between the credit and the debit, there will be a balance of capital account. So capital account can experience a balance when there is a equalization between credit side and the debit side. Now we will move on to the next topic, that is how to differentiate the capital account and current account. In a nutshell, we have learned about current account and capital account. I am going to differentiate these two in a nutshell. I have written everything here. That is difference between current account and capital account in a nutshell. Now I told you, when you write the answers, if it is asked as differentiate something for economics exam, you have to draw a table and you have to write on what basis you are going to differentiate the two concepts. So I have drawn a table where it is divided into 3 columns, and the first one represents basis, second one represents as current account, and the third one represents as the capital account. Now the first column, on the basis of meaning we are going to differentiate capital account and current account. So first we will see what all things in current account. Now first differentiation on the basis of meaning. Current account records all transactions between the country, let us assume it as India, and the rest of the world, which do not cause us any change in the assets and liabilities. I hope it is clear, because current account consists of 3 components. Which are they? Visible items, invisible items, and unilateral transfers. This will not cause any change in the assets and liabilities. That is why the first difference on the basis of meaning is written here as records all transactions between the country and the rest of the world which do not cause any change in the assets and liabilities. Now whereas capital account records all transactions between the country and the rest of the world which causes change in the assets and liabilities. Definitely, you know, capital account consists of capital receipts and capital payments. Therefore, it causes a change in the assets and liabilities. So on the basis of the meaning, we have differentiated capital account and current account. Next difference is on the basis of concept. Now, the current account is measured over a period of time, but whereas capital account is measured on the basis of point of time. Now why it is said like that? Period of time is a flow. Point of time is a stock. What is a flow and what is a stock? I have explained the difference between flow and stock when I took the chapter money and banking. Hope you all remember that. Flow is water in a river, stock is water in a tank. Now we are trying to relate the current account which measures over a period of time. Now just think what all components are there in the current account: visible items, invisible items, unilateral transfers. These happens over a period of time. Best example, flow of goods and services. Always it is happening. Every minute, every second it is happening. Flow of goods and services. That is why it is considered as measured over a period of time. But whereas capital account, it is measured over a point of time. Why it is said as a point of time? It happens at a point of time. You know, all the things which are related to capital receipts and capital payments are included in the capital account. For example, RBI, banking capital, is one among the component of capital account, banking capital, am I right? RBI sell and buy the foreign exchange reserves from the foreign exchange market whenever the situation is favorable for them. Investments are done whenever the situations are favorable for the investors. All these can cause change in the assets and liabilities. Everybody is concerned about the assets and the liabilities. Simple example that I can give you: public will take the loan from the commercial banks only when the rate of interest is low. So all these depends on a particular point of time. It is a stock concept. So investors will be taking the investments only when the situations are favorable for them. That is why we say it is measured at a particular point of time, because everybody is concerned about the assets and liabilities. Now the next one, on the basis of components. What all components are involved in the current account and capital account? I need not explain it again. You all know it. You have learned. The current account consists of visible items, then invisible items, unilateral transfers, whereas capital account consists of private transactions, official transactions, portfolio investment, FDI, and banking capital. This is what about the difference between capital account and the current account.